investment opportunities in Los Angeles. I'm Anna Magdanian, publisher and CEO of the Los Angeles Business Journal, and I'll be moderating today's panel. Before I introduce today's speakers, I'd like to go through a few housekeeping items. First, today's webinar is being recorded. A link to the recording and a downloadable PDF of the webinar presentation will be emailed to all later this week and also available on Arbor's website on arbor.com. We'll also have time for a Q&A session after the webinar presentation. So please submit any questions you have using the question tab on your control panel. You can do that at any time during the presentation. If we're not able to get to your question, an Arbor representative will get back to you individually, and we will have contact information available to you at the end of the presentation. The panelists on today's webinar are Barbara Denham, Senior Economist in the Economics Department at Reeves. Her team is responsible for the firm's market forecasting, valuation, and portfolio analytics services. In this role, Barbara has written a number of white papers on the commercial real estate market. She also co-writes Reeves' First Glance and the Preliminary Trend Report. She's joined by Kelly Hadigan-Cho and Jerry Lamb of Freddie Mac Multifamily. Kelly is a small balance loan production and sales manager for Freddie Mac, Western Region business. She's responsible for loan origination in 3 offices covering 11 states. Kelly has been active in the small balance debt market for 10 years, having previously worked as a loan originator at CBRE and Grambridge Real Estate Capital. Jerry Lamb is a small balance loan director of underwriting and credit for Freddie Mac's Western Region business. He's responsible for the strong partnership between production and underwriting while delivering certainty of execution to our sellers, servicers, and affiliate relationships. Prior to joining Freddie Mac, Jerry managed similar roles, having previously expanded the small loan origination platform at Barings Capital on both the credit and production fronts. Dustin Pavir, the Vice President of Agency Lending Operations with Arbor Realty Trust. He has been with Arbor for over a decade. In his role, Dustin oversees the front-end screening and underwriting of Arbor's small loan group. He's been involved in Freddie Mac's SBL program since the inception in late 2014, and he works closely with Freddie Mac's production and underwriting. Today's webinar will kick off with a macroeconomic overview of the Los Angeles market and its multifamily market fundamentals. Then we will move on to a discussion of Freddie Mac's small balance loan program and its role in the small multifamily market. The webinar will conclude with a look at the size of the small loan market, the small balance case study, and some tips, key tips for small balance borrowers looking to secure financing. To start us off today, I'm going to ask Dustin to tell us a bit more about Arbor.
Thanks very much, and thanks everybody for joining. So Arbor Realty Trust is a leading provider of debt capital for both, commercial real estate and primarily multifamily. Multifamily is really Arbor's bread and butter. We are very active. We're a very active agency lender with Fannie Mae and Freddie Mac, and for many years have been very active in the small balance loan space. For years even before the Freddie Mac SBL platform was launched in late 2014, but small loans have been in Arbor's DNA, if you will, for a long time now. So the Freddie Mac SBL platform was really a natural fit for Arbor, and we're very proud of the volume that we've done with Freddie Mac. It's been a great partnership, and we're very proud to be a top Freddie Mac SBL lender. We've invested heavily in technology over the years as well to make the loan process as seamless as possible for our borrowers. And Arbor is a, approved Freddie Mac seller servicer, meaning that once the loan closes, we service the loan throughout the term, and the contact with Arbor continues. So that's a bit about Arbor. I'm now going to pass it over to Kelly Cho to cover Freddie Mac's multifamily business.
Thank you, Dustin. Freddie Mac really is a leader in multifamily finance. We're combining innovative solutions with expert risk management. First and foremost, our mission is to provide liquidity, stability, and affordability to the U.S. housing market from coast to coast. And this really drives everything that we do. More than 80% of the apartment units that we fund each year are affordable to renters earning local area median income or less. Our focus is on workforce housing, which is, families earning less than 80%, affordable to families making less than 80% of AMI. About 90% of our loans are securitized, which significantly reduces the risk of future losses for Freddie Mac and for the taxpayers. And this really differentiates us from Fannie Mae. And our product offering includes conventional, targeted, affordable, seniors, and student housing financing. Now we'll kick off the webinar with a macroeconomic overview of the Los Angeles market and its multifamily fundamentals. Barbara, take it away.
Thank you, Kelly. So on slide 6, I show the agenda. We're going to talk a little bit about the macro economy, and then I'm going to zoom in on the employment situation in the California market, specifically about Los Angeles, and then really look at the apartment market in Los Angeles. So just on slide 7 here, this shows the macroeconomic picture vis-a-vis the GDP growth, which is the red line, and the job growth, which is the blue bars as per the left-hand axis. The blue bars show, both lines actually show how steady this employment growth and GDP growth has been in this expansion, and this contrasts previous expansions where it really moved in booms and busts. A lot of people are, it's 8 years deep into this expansion, and so many people are worried that we must be close to a recession just based on the fact that it's been so long. And what I'd like to convey to you today on this slide and on the next slide in a minute is just that this picture is so dramatically different because of the way we've grown. We've grown at a slow and steady rate, but I would argue that that's healthier. We have not seen the asset bubbles that we saw in the past, and that has kept a lid on the rate of growth, but it's also helped planners plan in that the rate of growth has not led to kind of the jumping on the bandwagon and the herd mentality for over-investing, over-speculating, over-development, and that's why our growth rate has been so healthy. I reiterate that on slide 8 here. This shows the cumulative growth in real GDP on the vertical axis and the duration of all of the expansions we've seen over the last 40 years on the horizontal axis. The red line shows the current expansion. As you can see, it's the second longest. We're only 2 quarters shy of the 1990s expansion, and yet we've grown at half the rate of growth. Again, it's been a conservative rate of growth, but most people are very cautious, and because of that, we have not overbuilt, overdeveloped, and I argue that that is why we are poised to grow. We are poised to continue to grow at this slow and steady rate because it's been healthy and we don't have too many overbalances, asset bubbles that we've seen in the past. Moving on to slide 9, I look at the job growth. I think job growth is a far better economic variable to look at when it comes to commercial real estate, especially the apartment market. When you see job growth, you'll see apartment demand, and we certainly see that across the U.S. However, what we're seeing is there's far more growth in metropolitan areas than in non-metropolitan areas, as this slide shows. The red line shows a little bit more accelerated growth in the metro areas. That's the recent 82 metros that we focus on. It's about 2/3 of the U.S. economy as a whole. The green line represents the non-metro areas, and the blue line is obviously the average or the U.S. total. And this slide shows a widening picture between the areas that are doing well and those that are much weaker on overall growth. And the interesting thing is that this contrasts so sharply with the past when they really used to grow at the same rate, and now they just clearly are not. On slide 10, I've taken this picture a little longer, and I've looked at all the California markets. Now, in the middle of that is the the black line, which represents the total U.S. growth, and then the dark blue represents the metro. All of them are very close. And even though Los Angeles, the green line, is at the bottom there, this is lower because Los Angeles did not see the same growth as the rest of the California markets did in the 1990s and in the early 2000s. But the rate of growth since 2008 actually has been pretty close to the U.S. average. And we can even see that in a couple of slides. But before we get into the employment numbers within Los Angeles, I'd just like to take your attention to slide 11, where I show the top markets and the bottom markets in terms of overall job growth. The top markets are largely in California, Texas, and Florida, and those that have not done well, mostly Midwestern or a few on the East Coast, but smaller markets in general outside of Chicago. The good news on this slide 11, is that every single of these 82 metros that we're watching and monitoring, they've all seen positive growth on a year-over-year basis, and that has helped the apartment market in terms of occupancy. Moving on to slide 12, I look at a table of all the job growth within the California markets, and as you can see, Los Angeles is only slightly behind the national rate of growth, both year over year and over a 5-year period. Its office market growth is just on par with the U.S. metro average of 1.8%. And the 5-year growth rate for the office employment is slightly below the U.S. Average of 11.5%. And the retail growth numbers are also lower, but that's probably a good sign. It means, the retail market is probably over retailed. And there's a lot of restructuring in the retail sector. So a decline of 0.5% isn't great, but it's a lot better than some markets like, say, Orange County and other places where we're seeing a lot deeper job declines. So moving on to slide 13. This shows occupancy across the U.S. and the trend here is we're seeing positive occupancy growth. And in most quarters, we're seeing a decelerating rate of growth, but it's still positive. And what you can see in this chart towards the right-hand side is there was a pickup in the first and second quarter. And I think the apartment market is still poised for more growth, mainly because the housing market is suffering a little bit more this year than it had been in 2017. So even though there's a lot of people know of the slump in the housing market, the interest rates are higher and prices aren't falling. They're actually rising overall. But the Tax Reform Act at the end of 2017 really cut a lot of the incentives to buy a home, not only because of the state and local tax deduction that was removed, but the doubling of the standard deduction meant that the mortgage interest deduction is not as available to anyone who has a mortgage below $600,000. So that really temporarily kind of slowed that pent-up demand for buying a home, and a lot of people probably got a lease renewal notice with very little rent growth. So a lot of people, again, put off buying a house, and this has helped the apartment market across the U.S. That's a good sign because, as we see on slide 14, construction growth has been very, very strong. The dark blue bars here represent supply growth. The light blue bars here represent demand growth. And as you can see, construction has been very, very strong. And the vacancy rate nationally has gone up over the last 6 quarters. It's really expected to continue going up for another 2 to 3 quarters. But the good news is the construction pipeline is expected to go down. So the vacancy rates should stabilize in the out years. Looking at this chart on slide 15, this shows the same supply-demand dynamics for Los Angeles. And as you can see, the vacancy rate in Los Angeles is expected to increase this year and next with all the construction coming online. And demand is still pretty strong, but vacancy rates should go up. But as you can see, it's still much lower than national average. It's below 4%. It'll go up to 4%. But rent growth is really expected to stay pretty strong. I'm going to briefly go through the national, slide 16 here. This shows just the national vacancy rate that's going up and the year-over-year effective rent growth. And it's decelerated, so it's still positive, but it has decelerated from 2015. 2016 was very, very strong. Again, it increased a little bit more this year because of the higher demand for apartments, because of the Tax Reform Act. But overall, the national apartment market is very strong. Looking at slide 17, this is the vacancy rate for all of the California markets, and as you can see, Los Angeles is well below the national average. Again, Los Angeles is that green line there. It's about 3.5%. That's extremely low. The only one lower in California right now is Sacramento and Ventura County. So it's a very good market right now. Here's the effective rent growth year over year. This is as of the third quarter. So it's the third quarter of 2018 over the third quarter of 2017 on slide 18 we're on now. And as you can see, it's really picked up this year. I'm sorry, it's stabilized this year, the green line there, but it's healthier in Los Angeles than it is in most of the other California markets, and it's actually higher than the national average. The one thing I think the takeaway, and you can print this out, what I like to do is, as you know, real estate is location, location, location. So this is all of the, not all of them, this is the top 20 submarkets. Reese monitors 37 separate submarkets within Los Angeles. And these are the statistics for the top 20 in terms of that last column there. It's ranked by year over year effective rent growth. And as you can see, some of the more desirable neighborhoods have seen the strongest rent growth over the year. Downtown and Beverly Hills, even South Central LA, where the vacancy rate is 1.2%, seeing very strong rent growth. So as you can see, some of these submarkets showing year over year rent growth of 10 to 15%, very, very strong. Some of these it's driven by the construction, which by that means rents are calculated on what's available in the market, and then for some of these markets, what's available is what's new and what's recently been built. So that's affecting the overall average, and that's why some of these are so high. But as you can see, with vacancy rates so low, landlords are very confident increasing rents. The other columns in this show what we call the excess supply. The 2018-2019 excess supply represents our total supply growth, meaning new construction in 2018 and 2019, minus what we have forecasted for demand or occupancy. So most of these show positive excess supply, meaning more will come online this year and next than will be absorbed. But as a percentage of inventory, most of those numbers are pretty low. And this is kind of like a proxy for how much the vacancy rate could go up in the next year. So for example, in Chatsworth, Canoga Park, we're looking at a little bit oversupply in this market. Vacancy rates currently at about 2.8% could go up to over 5%. But with rent growth of 4.9%, it's still poised to grow and see positive rent growth. So these are the top 20 in terms of this parameter, again, this effective rent growth. The next slide, slide 20, shows the bottom 17 submarkets that we're monitoring. Again, it's all ranked by this effective year-over-year effective rent growth, all of which have been positive, even in Burbank, where we are seeing a little bit of negative net absorption, low vacancy rates, but still positive rent growth, really because of the kind of the momentum in the market overall. I should point out that in downtown, so much of the construction is in downtown, and this kind of national movement of millennials and other people into the urban core is really pronounced in Los Angeles, and it's really changed the downtown dynamics, but I think it's a healthier market. And I think that trend of the dynamic downtown that Los Angeles has experienced should continue. And we'll probably see that in other markets because it's been such a successful model. Moving on to slide 21, this is the same idea, that kind of excess supply and comparative statistics in terms of the overall effective rent growth rate for Los Angeles and all the California markets. As you can see, Los Angeles is better than most of the California markets, but they're all pretty healthy. And finally, I want to just talk a little bit about interest rates and cap rates. Slide 22 shows the spread between the national cap rates and the 10-year Treasury. Most of these are still well above their 10-year low, other than the apartment market. So apartment cap rates have been trending lower, which defies the expectations of a rising interest rate environment. Usually cap rates move in step with interest rates, and for the apartment market, that's just not the case. The demand for buying apartment properties has been very high, both for domestic investors, institutional investors, and for global investors, and that has kept the cap rates lower and lower. And the spread between the cap rates and the 10-year Treasury rate has narrowed, and as this chart shows, it's actually at where it was 10 years ago, almost exactly, but it's above the kind of dangerous levels we saw in 2007, when we were still in a bit of a credit crunch, or the housing bust and the credit markets that went crazy back then. So we're watching this, but a lot of that kind of compression is due more to the fact that the 10-year has been higher in the last 2 years than the cap rates falling. And that's another reason why you see some of these other spreads narrowing. Office cap rates are flat and retail cap rates are rising, but the spread has been lower, more because of the drive in the 10-year than the cap rates. So moving into the slide 23, this shows you the cap rates for the 3 markets in Los Angeles. Again, the blue line showing the apartment cap rate, pretty stable, but slightly lower, which again, this is not the spread, this is the actual cap rates, and it's been pretty low, even though the interest rates are rising. You can see the office cap rate has been rising, the retail cap rate has been rising. It only fell recently, but that's only because of the volatility nature in cap rates, which is based on what's traded, not necessarily based on the property's values. Another note about the interest rate concerns we've seen, which is that the fear of the inverted yield curve is such that a lot of people worry that this is a sign of a recession. I have a big blue arrow there showing that in 1998, we did see an inversion of the yield curve for a good month, and we did not see a recession. We also saw 3 periods in the 80s and early 90s when we came very close to an inversion, and we did not invert. So I just point that out in case those people who are very concerned that our close proximity to an inverted yield curve might yield a recession. So I would, we're monitoring this, but I wouldn't be that concerned. So finally, I want to move on to slide 25, which is our conclusion. Our outlook is for positive growth going forward, maybe a slightly, the GDP growth rate being slightly below 3%. The multifamily market has weathered the supply challenge that we've seen pretty well and at a very healthy pace, and we think that should continue, again, a lot because of mortgage interest rates and the Tax Reform Act, which will keep demand for apartments pretty strong, but it's also job growth. As long as job growth is positive, the demand for apartments will stay as strong as they have been. The only concern I have is for the long-term deficit, and with the Tax Reform Act, our deficit is growing every month, and that will have a disproportionately negative impact on interest rates when we do need to lower them should we face a recession. So with that overview as a backdrop for the Los Angeles apartment, I would like to hand this over to Kelly, who's going to talk about the small business loan programs. Kelly?
Thanks, Barbara. And so Freddie Mac created a small balance loan program in 2014. We had previously offered smaller loans to existing clients on a one-off basis, but we saw an opportunity to provide liquidity in a market that's typically very fragmented. It was more efficient to have a team exclusively dedicated to the small balance space than to have our conventional team do these deals on a one-off basis. We were able to leverage our existing seller servicer relationships to create a really dynamic program. So when we launched in 2014, we did 2 loans, I think, for a total of about 50 units. And as of the end of 2017, we had closed $6.9 billion with 101,000 units just for the calendar year 2017. So we've had extraordinary growth over the past 4 years. And our market share has grown significantly over time. I think we're now at the end of 2017, we were at about 13%. Our loan amount is really $1 to $7.5 million in high cost areas. That's how we define small balance at Freddie Mac. And 5 to 50 unit properties are our bread and butter, but obviously we go well above that 50 unit threshold depending on the market and location. With that, I'll pass it off to Jerry to go into more detail on our loan terms for the small balance program at Freddie.
Absolutely. I mean, one of the key advantages of Freddie Mac is definitely wanting to listen to the market and what the market is asking us to do. One of our vision at Small Balance Loans is our relentless pursuit of workforce housing unit by unit. We look and listen to the market, and we provided great terms. Some of the terms include 5, 7, 10-year terms, fixed to hybrid structure, interest only up to 80% loan to value. Definitely trying to innovate and deliver cost-efficient capital to best meet the smaller apartment needs. We look to capture this market space as soon as possible. And as you can see, the direct impact and growth, we call it the hockey stick, from 2014 to year to date, definitely making an impact in small balance space. So looking to continue that environment. And we're using, with Arbor in lockstep with Freddie Mac, we're able to continue this growth pattern. And I would like to pass it on to Dustin to talk a little bit about any type of exceptions into our program.
Sure, thanks, Jerry. As it indicates here on this slide, right, the typical profile is, obviously 5+ units, $1 to $6 million limit for properties in nationwide markets with the ability to go up to $7.5 million on top in standard markets, up to a maximum unit count of 100 units. That's not to say that we can't occasionally do a $7 million loan on a property with 125 units. There's exceptions for that type of product, and that is out there and reviewed frequently. So, also too, with respect to the minimum unit count, 5+ units, that is what we look for. There is some flexibility to occasionally, if we have, for example, 3 adjacent 3-unit buildings, all contiguous, all operating as one, there's the ability to execute on that type of product under the SBL platform now on an exception basis. So, there is, there's a big footprint that the SBL platform has nationwide. And on the next few slides here, I'm just going to get into some discussion on just the size of the small balance market nationwide and where Arbor is more active. So, this slide here, it's very interesting to see, right, that the large loans out there, meaning loans above $10 million, make up a significant amount of the volume of the overall multifamily market, right? But in terms of the number of transactions, there's a significant amount of business out there with loan amounts of less than $3 million, right? 45% of the market, and then taking that a step further, between 3 and 10, another 33%, right? So in terms of the number of transactions in 2017, the small balance space, and I understand that, we're talking about up to $7.5 million, but just in terms of the global, 10 million and under, that's almost 80% of the number of transactions, right? So a significant amount of business out there where both Arbor and Freddie are very active. And on the next slide, I'm going to talk here just a little bit about the growth that we've seen in small balance lending really over the last few years, right? So in 2009, the small balance market, meaning the criteria on this slide being between 1 and 5 million, the activity was $11 billion, and that's has risen to nearly $50 billion in 2017, with 2018 more or less on pace for similar production as we saw in 2017. So, activity continues to be very strong, and we expect that to continue. So on the next slide here, we have a few states highlighted where Arbor is most active in the small balance space. Arbor is very active along with Freddie Mac really across the entire country, all 50 states. The small balance program is very competitive and very active in quote unquote top markets, and we see that here with California being highlighted, as well as New York and New Jersey, right? The New York City MSA as well as the Los Angeles MSA are two of the most active metros for Arbor in the small balance space. But that's, we are also very active, as we can see here, in Texas as well as in the Southeast. And typically in those states, we're talking about more standard or sometimes even small, very small markets as they're classified with Freddie. So we're very active on both coasts all across the country, and we can see this here a little bit as well with the red dots just indicating where Arbor has regional offices to support the production. So very active across all states, and especially with these states highlighted here in green. So on the next slide here, we're just going to talk a little bit about a case study, right, which is a good example of an Arbor SBL loan that we worked with Jerry and Kelly on to close for our clients earlier this year, right? And we picked this particular transaction as it's a relatively standard situation that we see in terms of a request for refinancing. And this is a 30-unit walk-up multifamily building in the Hollywood section of Los Angeles. We worked with experienced local sponsors who have a large portfolio of similar-sized assets, primarily in that 5 to 50 unit space that Kelly had mentioned earlier as really being the bread and butter. So the borrowers here were very experienced in this space, and on this particular transaction, this was a refinance. They acquired the property about 18 months ago and performed some capital improvements and came to Arbor and Freddie to look for a refinance to pull some cash out after having completed their capital improvement program, after having a period of several months of stabilized operations, with increased NOI, and the increased NOI supported a cash out refinance. We still did see some post-closing equity remain in this transaction, but they were able to pull some cash out after about 18 to 24 months of ownership. This particular transaction, they utilized the 5-year hybrid product, right? So the SBL platform has options of 5, 7, or 10-year hybrid or fixed rate product. The hybrid being, in this particular instance, fixed for the first 5 years, then floating for 15. So it's really a 20-year term on a 30-year amortization schedule. This was underwritten subject to a 120 DSCR. It did have 2 years of interest only. The program, the standard for the program in that scenario is 1 year of interest only. However, with this particular transaction, given the equity that the borrowers retained in the property, given the track record that they had with Arbor and Freddie Mac and their just overall experience in the market, we were able to offer a little bit of additional interest only in this particular transaction. That was important to them. All the SBL loans are non-recourse. I know some of the bank loans out there would be recourse, but non-recourse here. And that I think gives a pretty good overview of this particular transaction. Just globally too, the SBL platform is very active as well in portfolios. So if we have a sponsor who has accumulated a large portfolio of assets and maybe looking to refinance 5 properties at the same time, we can execute on that, and frequently do, and sometimes there's economies of scale in terms of the costs and pricing and everything like that. So this is a one-off transaction, but there's a very strong portfolio execution under the SBL platform as well.
Right, and Dustin, I want to add.
Go ahead, Jerry.
Although we were, this is a repeat sponsor, local sponsorship, as you mentioned. I also mentioned earlier that Freddie Mac is our relentless pursuit of kind of workforce housing, and we actually met up with the sponsors of this particular transaction and really got to delve into the relationship with Arbor, relationship with the sponsor, really understanding the story and the mission behind their product. They're mission driven, meaning they not only support workforce housing, but even if you look deeper into their operations of their general contractor to property management, there is this aura of wanting to do better and wanting to do better for the firm and also the community. One thing that we learned from this relationship is that they're not only out there for that profitability, but also wanting to satisfy the affordability in that neighborhood. So that's something that they preach, and we were able to really get into the depths of it with the management firm, in addition to our sponsor. So definitely a great case study to be representing here.
Sure. So just a little bit about technology in the small balance space. I alluded to it earlier, right? But Arbor has been innovating with technology, and in 2016 launched what we call Arbor Loan Express, right? Which is really just an online platform to make that loan, the initial loan screening process and subsequently underwriting process as efficient and user-friendly as possible. It's somewhat of a new innovation in the multifamily space. Everybody, I'm sure, is familiar with Rocket Mortgage and Quicken Loans. And this in the multifamily space, what we try to do is just make the process as seamless as possible, allow borrowers to upload required documents directly to a site to see, to track the progress of their loan throughout the entire process. So we're very proud of the Alex Plus platform and think that provides a great experience for our clients.
Okay, thank you to our panelists. That was a very informative presentation. Now we are going to head into the Q&A portion of this webinar and take some questions from our listeners. Looks like we've got a few questions already posted, so I'm going to go ahead and start with my first question here from the audience. How has the small business lending landscape evolved over the last decade? This is directed to our panelists.
I'll take that question. I think that historically the small balance lending landscape has been extremely fragmented and dominated by relationship banks and lenders who would kind of do a favor for a borrower to accommodate these smaller loans. But really over the last 5 years, we see a lot more lenders who truly specialize in the $1 to $10 million space between both Fannie and Freddie. And I think also at Life Cos and even a lot of the bigger banks, they have true small balance groups, which has really made the marketplace, I think, more efficient, and it's really enhanced the liquidity and the stability in the small balance market.
Wonderful, thank you. I'm going to go on to our second question. It looks like, okay, here we go. What are some of the tips for first-time small balance borrowers for getting started with securing financing?
Sure, this is Dustin. I'll take that one. The case study that we discussed earlier obviously had to do with very experienced sponsors, but that's not to say that the small balance platform isn't a good fit for borrowers who maybe are just getting started or have less experience, maybe 1 or 2 properties under their belt, right? But in terms of somebody just getting started in multifamily, right, we want to think about what loan terms are going to line up with the goals for a certain property, right? So the SBL platform has 5, as I mentioned earlier, 5-year hybrid product, right, with more flexible prepayment structures, right? So if somebody thinks about acquiring a property with a shorter hold period, perhaps a 5-year hybrid with a 3-1 open prepayment structure would be a good fit, right? Whereas longer term holds for a borrower who wants that fixed rate certainty, a 10-year hybrid or fixed would probably be a better fit there, right? So we got to think about what terms line up with the strategy for a given property, whether it be an acquisition or a refinance, right? But for somebody who maybe doesn't yet have any multifamily ownership under their under their belt, we would look for that individual to partner with a local, respected third-party property management firm, or potentially partner up with a more experienced sponsor who has done deals, and we would look for somebody to partner up that way.
Wonderful. Thank you, Dustin. We're going to go with our next question from the audience. What are lenders typically looking for when applying for a loan?
Sure, it's Dustin again. I'll just very high level. The basics that we would look for when somebody is submitting a package for a new loan review. Rent roll, historical operating statements, personal financial statements, real estate schedule, just to get a sense for other assets owned in the market, how they're performing. Obviously details for the subject property in terms of pictures, so we can get a sense for the asset quality and everything like that. If it's a acquisition loan, right, we would want to review the purchase and sale agreement, and for a refinance, where the property maybe has been just acquired in the last 2 or 3 years, certainly important to understand the total cost basis there in terms of not just the acquisition price, but capital improvements after acquisition, which is part of what we saw in that case study there earlier.
Great, thank you. I'm going to go on to our next question from the audience. We got, can you name some of the advantages of a small balance loan through Freddie Mac program?
Sure, I can take that question. Some of the advantages of small balance loan programs include, first and foremost, non-recourse. We are a cash flow lender. One of the things that I want to highlight is the 35 business day rate hold. That is a tremendous advantage to the program versus other programs where they are stipulated or in lockstep with the interest rate environment increasing. Our 35-day rate hold allows for that certainty of execution, and also a little bit of that rate anxiety is alleviated. Also, during our kind of cash flow lender kind of perspective, for the right story, we have lean-in acquisition financing. What does that mean is if you are looking at an asset in the LA basin and you're looking to acquire that asset, but there's about 2 units or a few units that are offline or vacant that you want to renovate post-purchase and add value and increase the rents to make sure you're in a better position financially. Freddie Mac will look at that as a lean-in acquisition financing. What that means is if your rents are severely depressed because you have located or identify a rent-controlled property, or you feel that the markets you see some upside in rental potential, Freddie Mac will underwrite that transaction given a certain level of rent levels applied to those vacant units. So you'll have some additional proceeds to work with during your financing, whereas other banks or other lenders will have to underwrite as is cash flow. I think that is a significant lean-in potential that Freddie Mac is offering. In addition, for the right story, especially for the case study and strong kind of proven track record sponsors, where lower leverage transaction below 70%, and in a really tight market like LA where vacancy is sub 5%, we also take that into consideration in developing and understanding the story behind your package, your asset, where we are taking into consideration the underwriting to less than 5% to again give you additional proceeds to work on a post-purchase basis. Those are some of the small balance loan advantages within the Freddie Mac small balance loan program that we find are extremely helpful in building those relationships.
Great, thank you, Jerry. How long does it take? This is looks like it might be the last question, but how long does it take to close a small multifamily loan from start to finish?
So it's Dustin, I'll defer to Kelly here in a minute, but just, I guess the short answer is it varies, right? As Jerry mentioned, the hallmark of the program is the 35 business day rate hold, right? And what that means is from the time the application is signed to the time the loan is submitted to Freddie Mac, the full underwriting package, right? So as long as that is done inside 35 business days, the rate from the application is held, right? So that's very important. So 35 business days is about 47 or so calendar days, right? And then Freddie Mac takes their standard period to review a loan, and then we work through rate and closing. So in general, 60 to 75 days, I would say, Kelly, and I'll let you jump in a second, but I would also say that it can be done quicker, right? For acquisition loans, we've closed definitely inside of that time frame that I just mentioned. A lot of that is just contingent on getting the required due diligence in a very timely manner from the borrowers, and working through everything. And for a clean package with quick due diligence, we can certainly move quicker. So that's kind of a long-winded answer, but Kelly, I'll let you chime in if you'd like to add anything additional there.
No, you said it perfectly. I think the biggest thing is Arbor and Freddie Mac are able to move quickly, assuming that we receive everything from the borrower in a timely manner. As long as all hands are on deck and we're all moving forward at the same pace, we can definitely move quickly. But on average, I'd say you're right with the 60 to 75 days. And not to beat a dead horse, but one more thing with the 35-day rate hold is that it is free, which sets us apart. We don't have a separate, rate hold deposit. Assuming that everything is submitted to Freddie Mac within 35 business days of the application being signed, that rate hold is free.
Thank you, Kelly. Okay, we are going to be concluding this webinar. I wanted to thank everyone for attending on the small balance multifamily finance and investment opportunities in Los Angeles. If we were not able to get to your questions today, Arbor will be in touch with you individually to address your questions. If you're interested in learning more about small balance market, you can also visit Arbor Chatter. It's Arbor's research blog, which has articles and reports and insights overall on the industry. Be on the lookout for a special upcoming small balance loan report focused on the Los Angeles market, which will be available on Arbor Chatter and on the Los Angeles Business Journal website. If you want to follow up with our speakers offline, please contact Arbor at the 1-800 number, listed on your screen, or send an email to email@arbor.com. Thank you again for Arbor for making this webinar possible. As a reminder, a link to the recording webinar of this downloadable version of the presentation will be sent to all registrants via email in the next couple of days. You will also be able to view the recording and download the presentation on the Arbor website on arbor.com. Thank you again to everyone for joining today's webinar.